Good morning, everyone. Welcome to this morning panel on monetary and fiscal policy interactions. When economists don't quite understand something, they, in recent years, use the expression nexus. So this is the background. We are still trying to understand what's going on between these two policies, and that's why we use this expression nexus. I don't know exactly what it means. My name is Dubravko Mihaljek. I'm a senior advisor at the Bank for International Settlements. That's, for those who don't know, the oldest international financial institution, a child of the First World War. And today it's a central banking institution. We do policy analysis for and with world's central banks in Basel, in Switzerland. And our panelists today are Waltraud from European University Institute, Tomáš from Czech National Bank in Prague, and Geoff from IMF representative office in Warsaw, taking care of IMF activities in the broader region of Central Eastern, Southeastern Europe. So our task today is to try to shed some light on current state of monetary and fiscal policies. We will, I guess, focus mostly on this region, but the issues there are pretty much global. My intention, or the way that I see these interactions at the moment, they mainly have to do with the stabilization role of both fiscal and monetary policies. But very quickly you get from stabilization role to other roles. For monetary policy, it's financial stability role. For fiscal policy, it's redistribution role and allocation role. Because this link between short-term and long-term is always a bit tenuous, and particularly at this juncture when there are so many structural changes in the global economy. So, to give you a background, for the past 30 plus years, monetary policy has been more or less dominated by the inflation targeting paradigm. This is a big invention of monetary theory in the 1980s. Central banks, starting with the Reserve Bank of New Zealand, started introducing inflation targeting. And the outcome was a fairly independent central bank with a clear mandate of pursuing price stability. And for many years, this mandate has been achieved. We have seen price stability around the world. And then in 2008, we had great financial crisis, and then a bit of rethinking of this mandate, in particular bringing financial stability dimension more closely to the price stability dimension. All this time, fiscal policy was viewed as a bit of a less discretionary type of macroeconomic policy. Fiscal policy was more or less run on an automatic mode. What economists emphasized were automatic fiscal stabilizers that help the economy ride out, smooth out business cycles. A big innovation in fiscal policy of the past 40 years are value-added taxes. This is a sort of equivalent of inflation targeting because value-added taxes turned out to be a money-making machine, and then they enabled finance ministries to generate enough revenue to focus on other dimensions of fiscal policy and not so much on what they were doing in the past, discretionary interventions to smooth out the business cycle. And then in parallel, fiscal rules. They were prominent in Euro area, European Union. They are also sort of equivalent of inflation targeting framework in that they constrain fiscal policy to certain types of actions. So everything was fine. We had great financial crisis, fiscal policy and monetary policy intervened together. Big expansion on both sides helped stabilize the global financial system. Then, unfortunately, in the US, fiscal policy turned contractionary too quickly. And that was the reason why monetary policy turned very expansionary, because not enough support was coming from fiscal policy at the time to resolve the fallout from the financial crisis. Europe had a similar situation, sovereign debt crisis in 2010, 2011. Again, it would have been good for fiscal policy at the time to support more the economy, but this was not possible because several countries in Europe lost access to markets. And then fast forward, 2020, pandemic crisis hit. Monetary and fiscal policy now worked very well together. They pulled in the same direction. Easing of monetary policy, big fiscal stimulus to overcome the effects of the pandemic. For 2 years, we were thinking the economy globally would come out of this situation in good shape. It did in many ways, but then another big shock hit, the war in Ukraine. And then again, fiscal and monetary policy work together in the right direction, in the direction of supporting the economy from energy crisis. Now the situation is fiscal policy is slowly consolidating after operating 2 years in this emergency mode. Monetary policy is focusing on fighting inflation, which is still stubbornly high. And then going forward, the issue that we would like to discuss here is how will the two branches of policy interact? There are some concerns that they may work at cross purposes again, as they did after the great financial crisis when fiscal policy was too tight. This time the concern is that fiscal policy might not be tight enough to help central banks rein in inflation. So that's the background, and let's now start with Tomáš, who is closely involved in monetary policy making. Thank you.
Okay, thank you, Dubravko. Good morning to everyone. First of all, I would like to thank to the Jagiello University and in particular to my friend Andrzej Slavinsky for the kind invitation to the beautiful city of Krakow, and of course the anniversary of Copernicus. It's a great opportunity to meet and to discuss topical issues. The nexus between monetary policy and fiscal policy, it is indeed very topical. To illustrate this, my fellow colleagues from the Czech National Banks are meeting just today with the Czech Prime Minister and the Czech Finance Minister to have a debate on an announced fiscal consolidation package in the Czech Republic. And this meeting was preceded by some tensions between the two institutions in media related to the previous lack of fiscal consolidation plans. So it's really something that's debated very hotly nowadays. Nevertheless, I would like to take a bit broader view, as suggested by Dubravko in his introductory remarks. We are now going through a kind of inflation crisis, and it's typically such economic crisis that lead us to rethink existing paradigms in economics. So what kind of lessons can we draw from this inflation crisis, and how much has it shaken our beliefs about the interaction between monetary and fiscal policy? It is remarkable that we've run into this inflation crisis after 15 years of fighting with ultra-low inflation or even deflation risks and very accommodative monetary policies. And the situation has changed so abruptly. No one has expected this. And in the previous 1 or 2 decades, there were actually moments, and not so far ago, when many people were questioning the ability of monetary policy to increase inflation from the ultra-low levels in the face of globalization processes that at the time were pushing structurally on lower prices in the global economy, and in the face of zero lower bound constraint. And there were debates on whether ultra-loose monetary policy in combination with ultra-loose fiscal policy could do the job. There was a debate about, for example, helicopter drop of money, a kind of fiscal transfer sponsored by monetary policy, whether this could be enough to overcome the zero lower bound issue and deflation risks. For a while, there was even some rise in popularity of the so-called modern monetary theory, which basically suggested that you can have unlimited monetary financing of fiscal spending without generating too much inflation, because Phillips curves have become ultra flat. So there are essentially no resource constraints, and the main issue is how to generate sufficient aggregate demand that would boost output and do a lot of social good without us having to pay any cost in terms of high inflation. Now, of course, the view on this has changed quite dramatically. We are going through an inflation episode that hasn't been experienced in advanced world since the 1970s. And we have learned that resource constraints are there again, essentially. Why was this? How I think after these 15 years of thinking about stimulating the economy and running loose policies, when the COVID shock hit, there were a few lessons from the previous crisis that were shaping the policy response. The first one was that monetary policy should act quickly and decisively, including unconventional monetary policy measures. After the global financial crisis, US that jumped quickly into QE recovered faster than Europe, that had to go through a serious debates on limits to QE in terms of legal mandates, etc. So the lesson was, do it quickly, massively. This will help you to bottom out very quickly, and then you can normalize monetary policy again. I think the second lesson was, don't rely on fiscal policy as monetary policymakers, because as Dubravko correctly mentioned, fiscal policy after the global financial crisis turned restrictive too early, and monetary policy had to do most of the job. And I think the kind of third lesson was you cannot overstimulate the economy by the combination of monetary and fiscal expansion, because first of all, the flat Phillips curve means that even if you overstimulate, it will have benefit in terms of higher GDP and employment, but little cost in terms of inflation. And secondly, if you learn that you've overstimulated, you can quickly withdraw the stimulus, and because you don't have any upside constraints, you only have the downside constraints in terms of the zero lower bound, you will be able to deal with the issue quickly. Now, what was wrong in this way of thinking? First of all, fiscal policy turned out to be much more expansionary during the COVID shock and then the Ukraine war than we could have imagined as monetary policymakers. There was a lot of support. The support was quite broad-based. The governments learned that they had to act quickly, and because of that, they basically often gave up an effort to provide targeted support, and they relied on broad-based support that, besides helping the affected people, was also generating a lot of macro stimulus. I think one lesson here is that for the future, fiscal policy should try to move to 21st century. The problem with targeted support is that when it comes to it, the government, and it needs to be done quickly, the government claims we don't have enough data to provide means-tested stimulus. But nowadays, actually, government is collecting a lot of data about people. The problem is that the data is dispersed and the government doesn't know how to use it, which is a bit paradoxical, because when you do anything on internet today, a lot of private institutions are collecting a lot of data on us, and they are able, for example, to make targeted advertisement. The new data processing tools, etc., are there, and for the future, the government should be able to use the data to make fast, targeted support in the future if needed. Secondly, what was wrong is that the idea that we cannot overstimulate. I think it was good to stimulate in the first phase of the COVID shock to avoid a complete meltdown of the economic and financial system, high unemployment, a lot of bankruptcies. But as time was passing, I think we underestimated the fact that the shock was a kind of stagflationary shock or supply-side shock. Simply the lockdowns have left a lasting damage on the supply side of the economy. So the supply side of the economy shifted down, and when this combined with a lot of stimulus on the demand side economy, the assumption of flat Phillips curve simply proved to be wrong. And thirdly, we haven't been able to withdraw stimulus in a sufficiently timely manner. In our region, most of the central banks started hiking the rates well ahead of the Fed, not to speak about the European Central Bank. But even this was not early enough to preempt the spike in inflation. And of course, fiscal policy is following suit with a much longer delay. And now in the Czech Republic, we are just talking about consolidation plan for 2024-2025, my understanding is that in Poland those debates are even a bit behind the Czech situation. And finally, I think what also needs to be taken into account, it's the idea that was spelled out in last year's annual report of the BIS, that we actually may have regime switches in the inflation process. Maybe we have over-relied on well-anchored inflation expectations from the past. The BIS essentially says that if inflation is reasonably low for a sufficiently long time, people understand that even large shocks to relative prices are temporary, and the second round and third round effects tend to be small. But once you shift to a high inflation regime, when people stop believing in the low inflation environment and they consider the movements in the relative prices to be actually movements in the general price level, it may be quite difficult to go back to the low inflation environment. And I think it's yet to be seen if the monetary restriction that has been delivered so far is sufficient to bring us back. I'm a bit scared or afraid that in the Czech case we might have not done enough. I firmly believe that next year inflation will go back down to low single-digit levels, but they may be well above the 2% inflation target. Inflation also seems to be fairly persistent in the advanced economies, especially as regards the core inflation process. Maybe we will be lucky thanks to the fall in global energy and food prices. Maybe fiscal policy is now going to help us more than it has done so far. But my personal belief is that monetary policy might have done more to make sure that inflation expectations are back and well anchored to the low inflation targets. So thank you very much for the moment, and I pass the floor back to Dubravko. I probably spoke a bit longer, but
this is fine. Thank you very much.
Okay.
It's all well noted and important. So Geoff, please.
Okay. Thank you very much, and it's good to be here. Thank you very much, and thank you to Professor Slavinsky for the invitation. I have a couple slides that I can hand out perhaps after for those interested that I will follow loosely. I'll cover some similar territory, but maybe first I could take a step back and say, what are we meaning by fiscal-monetary nexus? In a very simplistic sense, one could think of it in two ways. One is the direct impact of fiscal policy on monetary policy and vice versa. And the second is the way in which fiscal policy should internalize the considerations and goals of monetary policy and vice versa. So for example, a tightening in monetary policy increases the cost of borrowing for the government in a direct sense. And similarly, expansionary fiscal policy pushes up aggregate demand and affects monetary policy. And then put in the second concept of a fiscal monetary nexus in terms of how you should internalize the other's considerations, there's an asymmetry. Fiscal policy, when we think of the mandate of fiscal policy, we generally think of it as growth, distribution, and stability subject to a debt sustainability constraint, whereas with monetary policy, we think of just stability, price stability and financial stability. So in a way, fiscal policy has a series of goals, one of which overlaps with the central bank. The central bank is not generally supposed to take into account the goals of fiscal policy, of fiscal dominance. You want the central bank focused narrowly. So right now we're seeing both of these concepts of fiscal monetary nexus play a big role in what we are thinking about in terms of our outlook and our policy recommendations. It's a particular challenge right now because I find that central banks that we work with they internalize, they think about what the impact of fiscal policy is on inflation, but finance ministries do not generally think about the impact of fiscal policy on inflation. They think about the distribution issues, they think about growth, and they think about debt sustainability, but not inflation. And that's why we get to this challenge of whether fiscal policy is doing enough to support disinflation. So today I'll focus on, in this first intervention, maybe 3 questions. First, how does inflation affect the fiscal accounts? Just a bit of a review. Second, how fiscal policy should respond to inflation. And the third, should governments offset the rising cost of living? And I'll take a little bit of a look at indexation in particular. Maybe in the second time we discuss, I'll talk a little bit about our outlook and the Polish context in particular. So the first point is that I think everybody generally assumes that inflation helps the fiscal accounts. The inflation tax is often referred to. I think it's important to recognize that this is not a fact of life. It is a reflection of particular characteristics of budgets, of economies, and of the inflation shock itself. So it tends to be the case that inflation, particularly surprises, help the fiscal accounts, but it's not inevitable. So why do fiscal accounts improve inflation? Why do fiscal accounts improve due to inflation? There's higher nominal values for GDP in the tax base. There tends to be bracket creep in the income taxes. Unchanged nominal spending ceilings in the budget. So spending on education is fixed at a level in local currency terms. And then there's some erosion of real value of debt. But the fiscal accounts deteriorate with inflation if there is indexation. So indexation of expenditures, indexation of tax brackets, and indexation of debt. For example, when your debt is linked to floating interest rates, the exchange rate, and inflation. And also if debt is of a very short maturity. What we see empirically is that improvements in the fiscal balance due to inflation, they do improve on average historically. The benefit is fleeting, so it exists for a few quarters and then disappears to zero. In our work, the impact on the fiscal balance goes to zero within 3 quarters of the shock of inflation. But the impact on the debt stock is far more permanent. So you get, obviously this initial impact on the fiscal balance helps, but the impact on the denominator helps as well. And you see that 5 years after the shock, public debt is around 1 percentage point of GDP lower, again, depending on the size of the shock. It also matters on how high debt is in the initial instance. This impact you do not get this benefit to the fiscal accounts if the increased inflation is expected, because markets have the opportunity to charge you more interest, and you can't get away with the inflation shock. So the second question, how should fiscal respond to inflation? Here there's a macro and micro component. And the 2 bottom lines that I'll just jump to is that fiscal should support monetary efforts at disinflation, which means a tighter fiscal balance. But within that budget, you should try and offset some of the negative distributional consequences. So what do we mean by this? So the direct impact of fiscal policy on inflation is via the impact on aggregate demand and then the output gap, referencing the Phillips curve that was discussed before. There is a lower cost to output and macroeconomic stability if fiscal policy helps monetary policy. And there's 2 reasons for this. The burden of demand reduction is spread beyond the interest rate sensitive sectors. So think of a given inflation shock. If you have only monetary policy responding, you need a much higher increase in the real interest rate than a case in which you're reducing aggregate demand with monetary and fiscal policy. So then you spread that burden beyond just the sectors that would be very affected by higher real interest rates. The second channel is that if you also have fiscal policy reducing aggregate demand to slow inflation, at the end of this period you have lower public debt, which all else equal tends to support macroeconomic stability. And I think it's important to emphasize that the way that fiscal policy should not support disinflation is via tax cuts and price caps. And we've seen that a lot in the recent period. It's extremely tempting to try and support disinflation that way, but it tends to be costly to the budget, leads to shortages, often is ineffective, and can make inflation more persistent. So now switch to the micro side. And again, I think these issues are extremely live right now in Poland because of the discussions around increasing universal child benefit programs. Here, fiscal policy has the agility and the mandate to offset some of the negative distributional consequences of high inflation. So the poor in particular suffer because they have less savings and because often the categories that experience the price shock are a larger share of their income basket. Here it's very important to be careful about how you assess the distributional consequences of inflation. There's three channels that we think about: the impact of inflation on the consumption basket, so if food is a higher share of what you consume, the impact on real incomes. Different sectors have different abilities to withstand the higher inflation and renegotiate. And the third is on the value of your assets and liabilities. The poor tend to have less interest-bearing assets, and they have less mortgage debt than higher income households. So what are our recommendations in these consequences, in these situations? The second is, the point is to address the distributional issue of inflation without undermining macroeconomic considerations, debt sustainability, and disinflation. And how do you do that? This gets back to what Thomas was referring to, which is the targeted support. We emphasize three things. The support should be targeted at the lowest income. It should be temporary, so it should expire as soon as the shock passes, and it should be cash-based. And it really is a function of, this just a side point on this, when the IMF has been encouraging poorer countries to do targeted support for years, and this has always been supported by the richer economies in our membership, telling poor countries that support should be targeted. Now we got to the COVID shock and inflation, and it was the wealthy countries saying that they didn't have the capacity to target to the poor. And I think this is really an area in which we should encourage governments to make progress here, because we really saw very, very little targeted support. Maybe I'll just, one more minute, and then I'll wrap up. I think the ways in which you can support and offset the cost of living impact, there's two main ways in budgets. One is via indexation, where the tax or spending item automatically adjusts to higher inflation. For example, pensions in Poland are indexed to the previous year's inflation. And the second is these transfers that I was just talking about. Indexation has a series of advantages. It's automatic, it reduces uncertainty, it preserves purchasing power, and it can prevent brain drain to the private sector. So you really do, if you set nominal spending on education at a certain level, and then you get a massive inflation surprise, your ability to provide government services at the same level it falls. But the negatives are quite clear. I mean, indexation pushes up inflation directly via more demand. It can push it up indirectly via increasing private sector wages. It makes inflation more persistent, and it complicates fiscal adjustment. And in my slides, we have a chart showing how indexation compares across different types of fiscal items and different countries. And this is quite important. Again, we could come back to this in the context of the 500 plus. So the bottom line on indexation is that the government has a key role to play in deciding who and how to protect. And you need to balance these considerations of supporting the most vulnerable versus supporting disinflation. So I'll stop here.
Okay, thank you, Geoff. So we now have a view from a policymaker facing difficulties in working together with fiscal authorities. We now have a view from IMF, how things should look like in practice. And maybe, Waltraud, you can give us a broader political economy perspective on these issues.
Happy to. Thank you very much. Thank you also for inviting me and give me the chance to interact with policymakers and those who look at policymakers and how to improve it from a supranational level. It's always one of these opportunities that are interesting. I will basically say that the idea that we could solve this once and for all by doing the right policy is a wrong way to think about it. There is a real underlying trade-off that you cannot cleanly resolve. And I will protect a little bit fiscal authorities against the permanent criticism that they are too pro-cyclical in every case. I think they have sometimes, especially over the last 15 years, been pushed into pro-cyclicality. And that is because there is a big elephant in the room, or as I will call it, the Frankenstein's monster, and that's the financial system. So it's not only about the monetary fiscal nexus that, as the chairman rightly said, we say nexus because that link, which we thought is the mix, as Geoff has set out, how we thought about the division of labor between monetary and fiscal authorities, that was all clean and nice in textbook. But I'm afraid it has never quite worked that way. And now, going out of extraordinary times, this becomes much more virulent than it is always. So I tried to make 2 points. First, in modern monetary systems, money is state money. It's a creation of the state. And second, and that makes the nexus a deeper nexus than just is the, say, the budget deficit aligned with the interest rate policy up and down of the central bank. And the other is that finance comes into the nexus. It is, in a way, a nexus between 3 sides. So let me just talk about the nexus, that it is not only a matter of aligned or non-aligned policy mix, as important as that is for stability and smooth business cycles. But if modern fiat money, the I create you, and there's nothing behind it than this promise that there is purchasing power when you next act on that promise that this money buys something, is a creation of the state, and it has the state behind it to make that credible. But as I said, like Frankenstein's monster, because the whole financial system builds on this public good of central bank money, you create it, but afterwards you can't control it fully. And actually, you should not. There should be a link, a buffer between the money creation that is the state's creation and the household of the rulers, the budget, because otherwise it is not credible that you will not abuse this and just finance that by printing money. So this is why a modern system, modern monetary system actually has to have a central bank that may be independent in different ways than we had understood in the last 20, 30 years, but it has to have that buffer. So I'm totally supportive of this role of central banks. And this is quite important to understand the difficulties of the present situation, I think. We had abundant liquidity in the last 15 years, and we had asset inflation. We still have asset inflation, overvalued assets for all kinds of things. And while at the same time, relevant sectors of the economy, of the non-financial economy, was actually starved of credit. Now inflation is so high, and inflation simply did not go up in the, so to think, for goods and services. Now inflation is so high that we can actually not say that central banks have become too austere. We still have negative real interest rates. While it is also true that bond investors get very nervous and ask already for higher yields in anticipation that some governments will struggle with the debt they have when these rates go up to service that debt. So I interpret this as a risk premium rather than as exact inflation compensation, as the quantity theory of money would say. So is this then a problem, as the chairman said, of monetary fiscal authorities not being aligned enough, and typically the fiscal authorities not doing what they should do? because governments are inherently always too pro-cyclical, always going, when the boom is good, then we hand out the gifts, and when we are in a recession, they can make the argument that, like any good household with good prudent management, should tighten their belt. Now, I'm not so sure that it's always the fault of the fiscal authorities. During the long drawn-out financial crisis, and I interpret the euro area crisis as the sovereign debt phase of a financial crisis, governments experienced that banks that they just had bailed out can turn the table on them and attack them, shun their bonds in bond markets, and that you therefore had to be very careful. And they kept more and more sitting on their hands and letting central banks to be these lone firefighters who flood the markets whenever there is a little blip of one bond spread or another. And so the governments were scared into too restrictive a policy. That is my interpretation. And now fiscal authorities feel they must support, as you said, Jeff, to support companies that simply cannot pass on rising energy costs and still have difficulties to get credit for any new business or expansion of business. That means that, in a way, it is true that fiscal policy is too expansionary. If you say only price stability, only inflation fighting would be important. And they are seriously in risk of getting overextended. Central banks, on the other hand, now have therefore to raise interest rates too fast, not too high, as I said already. I mean, we are in negative real interest rate territory that 20 years ago we would not have thought that is possible, that you have minus 5% real interest rates, right? And some banks buckle. Interestingly, more in the United States than in this heavily criticized continental Europe with its overbanked economies and so on, where banks have not buckled in the same way as they do now in the United States. And this is the problem for inflation-fighting central banks. That the governments have aligned interests with the banks, namely, if in doubt between inflation or price stability and financial stability, they want the central bank to go with financial stability in the sense of just tide us over this with lots and lots of liquidity, because that allows us to support our real economy with direct subsidies and stuff. And the banks, of course, like it because it keeps them doing what they like to do, namely finding assets, growth assets, into which they can pile loads and loads of money. And this is that means inflation stability is a real uphill struggle for central banks to put through. And that brings me to the second point, that elephant in the room, or monster in the dungeon, if you will, of the fiscal-monetary nexus, and that is the financial system. The central banks are put because there are is the financial system that has got so used to this extended liquidity that they cannot stabilize straight away as they would have done. And as the theory would tell us, that's the first and foremost role. No, financial stability is always and is almost the primary role or the primary goal of a central bank as well. First of all, because money is state money. If in a systemic crisis the sovereign goes down, then the central bank is out of business, right? And it needs the financial system at the same time as an infrastructure for its monetary policy. That's because it is the buffer between two, and it has made, in a functioning capitalist economy, the financial system is the gatekeeper to employment and investment, and therefore there is an inherent structural institutional dilemma for any central bank between this. It cannot refuse to bail out banks or governments if this is, a systemic problem. Otherwise, it risks instability that could bring us all down. They must act to maintain the system. They have the big, deep top pockets. They can act more swiftly. And importantly, they can coordinate across jurisdictions internationally, something that private reinsurers have never been able to. So the problem then is, how can you avoid being exploited constantly instead of being the reinsurer, the insurer of the primary insurers of, for catastrophic risks, for excess loss? Instead of being that of last resort, you become the reinsurer of first resort. Because you can act, it can be exploited. And that, I think, will be a permanent struggle, but it can be done in two ways they show us at the moment. One is determining what is excess loss, what you will have to cover, and what you will not, which has to be borne by banks themselves or by by fiscal authorities who have misbehaved. And while this United States has just shown us in the Silicon Valley Bank how not to do it, because they said basically we cover everything, Andrew Bailey at the Bank of England has shown us how you can do it, even as a relatively small central bank, when the pension funds that had hedged against falling interest rates, and interest rates were going up because Liz Truss thought she can just do a dash for growth in a time when it is very unlikely that it will do anything in this uncertain geopolitical situation we are, then he said, okay, I offer you to buy, even though I just announced that I will now buy bonds and not sell bonds anymore, sell bonds and not buy bonds anymore. I will buy your bonds from you pension funds at this floor price. I guarantee you that. And it turned out that the pension funds who had shed these bonds did not take him up on the offer. They were waiting for a better offer. And he set them an ultimatum in Washington and said, if in 3 days you don't take up my offer, it expires. And everybody thought, wow, he does a gamble that is just crazy. It will all collapse on that Friday. Nothing happened. He had called their bluff, that they were not seeking reinsurance for a catastrophic loss, that they were looking for insurance that gives them a huge profit. And this is the kind of things you have to think about as a central banker. Everybody had thought Bailey is crazy, and he turned out to be the wiser of them all. The second is, while it is very risky to create always these finite funds, the EU or the euro area in its risk fighting, in its crisis management, has often created these finite funds or finite purchasing, asset purchasing programs. And this is risky. Kindleberger once told us any finite promise to intervene in markets by the authorities tips the hands in favor of the speculators, who can exactly see when the fund runs out, and then they preempt it, and the run starts. However, in the situation that we are now, where I think we go back to normal, to create a few backups, fiscal backups for transnational fiscal backups for the central banks, like an ESM, the European Stability Mechanism, in search of a role, frankly, as something that can step in and is a backstop for the single resolution mechanism of the banking union. That is the kind of things you have to signal to the markets this is not infinite, because central banks can act almost infinitely. You say this is the amount you can get, you can take it or leave it. But this is what we have for resolution of banks, for example. And that will kind of prevent that they tie their hands and not always be the reinsurers of first resort. Thank you very much.
Thank you, Waltraud. So we have a new player. We had only central banks and finance ministries in the first round. Now we have a third player, very powerful, very important one, the financial markets. And we also started now to talk about what could be done to help both the disinflation and a measure of fiscal and financial stability. So reactions, please. Tomasz and Geoff.
Thank you. There have been many very interesting and important thoughts so far on the panel. So just a few remarks. I fully agree that we cannot put all the blame on fiscal policy, especially when we debate the fight against inflation. We need to realize that this is not the primary responsibility of fiscal policy, and besides that, fiscal policy has many other roles. So including the redistribution in the economy, etc. So for me, for example, when I now talk about the need to consolidate fiscal accounts, for me it's primarily to assure that there is long-term fiscal solvency. Any kind of help that comes with it in terms of fighting inflation is a welcome byproduct for central bankers, but the central bankers cannot demand the fiscal policy to do most of the job. It's really our mandate. We have independence to do even quite unpopular measures. And maybe the question now related to the remark about still sharply negative real rates is why we haven't done more. Is the central bank independence, which is typically quite strong on paper, somehow constrained de facto? Why we started to respond late, while some of those central banks, including us, that starting to respond early, stopped halfway? Was there, in the end, too much concern about other policy goals than just price stability that prevented us from delivering on this idea that if we overstimulate, we can very quickly withdraw that stimulus? Why this has not happened? I think this needs to be discussed and assessed, and possibly some institutional changes might be needed to strengthen the de facto independence of monetary policy. Of course, one of the constraints might be financial stability. You would like to tighten quickly because of price stability objective, but it might run into conflict with financial stability. My feeling about the Czech is that so far this hasn't been the case. We haven't seen any negative side effects of tighter monetary policy in terms of financial stability issues. But in some other countries, this has played an important role, including the euro area. I agree that bank resolution frameworks are key here. I believe that Europe has done quite a lot of progress in terms of making sure that when banks go bankrupt, it's the shareholders that get the first hit, and fiscal is only the last in the row. But there is always a moral hazard issue. You design this in ex ante, but when a crisis hits, you have a temptation to bail out everyone, often not using fiscal money, but central bank money. This is for me another issue, how to really make sure that the resolution frameworks that are put in place ex ante are then followed ex post when a crisis hits. These were just a few chaotic thoughts responding to the panel, but again, it's a very interesting debate.
Okay, I agree. Many interesting points raised. Let me say three things, I think. The first is, I agree you cannot put all of the blame on finance ministries. It is a very different job working in a finance ministry than a central bank, BIS, IMF, academia. You have many more responsibilities. You tend to have lower pay, and you have a lot of criticism from the press. So sitting in these more comfortable bureaucratic positions and saying it's all the finance ministry's fault is not fair. That said, I think if you have an overheating economy and overly high inflation, monetary and fiscal policy should be in a restrictive position. I don't think it's unreasonable to get there. If you have expansionary fiscal policy at a time that your economy is overheating, you're chasing your tail, pushing real interest rates higher, and raising the risk of financial stability problems. So working together within reason sounds reasonable to me, but again, it is this overall tightness in fiscal, but within that, making sure that you are expansionary in certain items to take care of the people that are most vulnerable. That's the first. The second is, I also think it is reasonable, as a professor raised, to think that if financial stability gets threatened, on average, policymakers blink and provide support to preserve financial stability rather than allow potentially disorderly problems in the financial system. It is what we have seen historically, notwithstanding the BOE example. And one reaction that the market could have from this is that if every time you get a financial stability risk, you get expansionary policy, fiscal or monetary, offsetting the desire for reducing inflation, you might then forecast that in the future, inflation on average will be higher and more volatile. And that then supports the change in regime that we were talking to a world in which inflation expectations are higher. Now, this raises the question of what you should do with that knowledge. I think it is difficult to encourage policymakers to allow financial stability to be threatened in order to prove a lesson. This was the big debate culturally between the US and Europe during the global financial crisis when Tim Geithner became associated with the view of a crisis is the wrong time to address moral hazard. And what came out of that was generally the belief that you should be doing this all ex ante via your regulatory environment. Now we've seen, as with what happened with Silicon Valley Bank, that this is difficult to do in practice. Political economy gets in the way and regulations are never what you hope for, or they don't always do enough. The Dodd-Frank in the United States has been gradually softened since the global financial crisis, and Silicon Valley Bank found a way to be outside of the highly regulated institutions. But I think it does raise a question where, to pivot this conversation to more of the monetary financial nexus, if from a price stability standpoint, you're being told to provide support, for example, via QE, is it possible that you are encouraging latent financial vulnerabilities via a financial system that's optimizing for this zero interest rate environment, such that if there is a sudden change in interest rates, you have financial stability problems, which is the question we are asking everywhere right now. And I think that the belief was that our stress tests were enough to take into account all of these issues, that maybe there were some problems in the non-banks, but the banks would be okay. But this is something we need to constantly readdress, or revisit to make sure that we get right. It is always going to be better to have a stronger ex-ante regulatory regime such that monetary policy is not dominated by financial considerations, rather than either bailing out a financial system or letting it collapse or letting problems emerge. So just to come back to the monetary fiscal nexus to conclude, I think our concern is that on average, monetary policy is a bit too loose and fiscal policy is not doing as much as we recommend. So while we do expect sharp disinflation, largely base effects in commodities with some help from supply chains, we worry that basically underlying inflation is going to get stuck a bit higher than targets. So if in the advanced world targets are around 2, we could see it getting stuck a couple percentage points higher. And in emerging markets, the targets are 2 to 3, and we could see it getting stuck 5 to 6. And so that's the reason that policy should remain restrictive and communication should remain clear about what they're willing to do.
Okay, thank you.
If I may just, just one paragraph. I'm glad that central banks now see that they cannot actually just do interest rate policy, and they need to care about redistribution, because they have, through their policies, redistributed massively over the last 10 years to the rich. Because this asset inflation means that those who hold assets, and this is the top 10% of any income distribution, has gained massively, while nothing has ended up with the lower middle classes. And that is also the reason why you now have to hand out energy subsidies so massively, because 50% of your population virtually is get close to poverty rates with these energy costs, or feel such social insecurity that as a democratically elected government, you cannot let that happen. Or you have riots, you have right-wing backlash, and so on. The Trump effect is there, and governments are afraid of this kind of majority backlash against democratic policy making that tries to go a bit more targeted, more reasonable, more rational. And this is the political difficulty that is there, which is why I think in the end it will be central bankers who have to hold the line, and they have to think about how to not get into this position of reinsurer of first resort. That was the whole message of what I said.
So I think it's a good time to turn to you, see if there are any questions from the public. Yes, please.
I'm Andrzej Wojtyna from Krakow University of Economics and the former member of Monetary Policy Council of National Bank of Poland. You have chosen the fairly neutral term nexus rather than, for example, dominance, okay, which is usually being used now in the discussion. But, well, you added later, let's say, the problem of financial, possibility of financial domination or dominance, whereas you avoided to discuss, let's say, the political dominance issue, which may be even more important than the other three, okay? And also by using the term nexus, you have not clarified whether even this, let's say, monetary fiscal policy nexus means a coordination or, let's say, uncoordinated game, like a prisoner dilemma game, whereas both authorities interact, but there is no actually ex-ante coordination, okay? And you may have sort of suboptimal then equilibrium. So it's just a general introduction, okay? But the question is, because taking advantage of having guests from abroad, I'd like to ask perhaps first Dr. Holub to tell us what kind of lessons for central bank independence would you draw from let's say, the recent situation? I mean, the experience during the pandemic and now during the war. Whether some of the weaknesses of the concept, but perhaps of practice of central bank independence as practice in the Czech Republic, have been revealed by those, let's say, crises. Okay, and particularly this dilemma, let's say, anchoring versus averaging, as it was emphasized by Professor Brunner-Meyer at Jackson Hole in 2021, for example, that if you don't say more precise what will be the length of return to your inflation target, that you risk, the anchoring of the expectations. And we now have this problem because we have still very low real interest rates, but then there's a sort of optimism on the part of the central bank that the disinflation will be quite fast, okay? But well, it seems to be unlikely. So do you see any I mean, what's your experience regarding this, how disinflation may occur in the Czech Republic, through which channels, given still, I think it was your, let's say, concern, as you mentioned, that you may be too optimistic also, but okay. And well, to Mr. Gottlieb, if I may, to ask directly, when you see, or you might have seen the banner on the Central Bank of Poland saying that those who are saying that it is due to, let's say, the government and central banks' policy that we have high inflation, subscribes to the Kremlin narrative. How would you respond to this kind of communication of the central bank? Because, well, it's our real problem now, and we are approaching election, and it's why I mentioned also political dominance, because, well, it's against any standards of central banking to I know it's a difficult question for IMF representative, but still I think it's very important for us how to secure stability in the future, both macroeconomic and financial. Thank you.
Thank you very much. Very good and relevant questions. I really believe that central bank de facto independence is crucial for us being able to do unpopular measures when needed. At the same time, there is always a kind of institutional dilemma how to establish central bank independence, because ultimately we are a democratic society. So the appointment processes to central bank decision-making bodies are always somehow in the hands of politicians. So even though we might want to have a kind of ideal independence, there are de facto constraints. I think in the US it was quite visible that the temporary story survived until the chairman was reappointed, and then the temporary story was gone, and they started tightening monetary policy. Maybe it was just an overlap, but you may question whether this was also partially associated with the appointment cycle. Are there ways to minimize the impact of those appointment cycles on actual decision making? In the Czech Republic, I think one of the weaknesses of our de facto independence is that we don't have good staggering of terms of the decision-making body. The board is composed of 7 people. In principle, is 1 person, 1 vote. But ideally, with a 6-year tenure and 7 board members, you would like to appoint 1 or at most 2 board members every year. And this would guarantee continuity in the decision-making. While in the Czech Republic, for historical reasons, the reappointments are clustered in a very short period of time. So, for example, at the moment, me and the governor, we are the only decision makers that were in the office when we were going through the hiking cycle. And there was a change in the board composition, and we stopped hiking at the level which is nominally high, it's 7%. But for a while we had inflation around 18. So in real terms, we stopped at relatively loose levels or extremely loose levels. And I think the appointment process has to some extent affected the policies. I don't have an easy solution. Maybe a better staggering in the Czech Republic would be appropriate. We also have a very specific, unique system that the President of the Republic has the sole responsibility to appoint CNB board members. But even in the past, there have been many rounds of debates whether there should be some approval of the nominations, for example, by the Senate, which works in some countries. It has its own disadvantages. I think the current experience will give another boost to another round of those debates, and I think it would be good to resolve those debates now, because in the past it was like, always the conclusion was, if it's not broken, don't fix it. I think here we have a case in which it has had an impact on our policies, and frankly speaking, my concern is that people are now legitimately complaining that the CNB has given up to some extent on its fight against inflation prematurely, and that as a result, the real value of savings has gone down significantly, and that we have done these steps to the benefit of largest debtors in the society, not just the government, but also the corporate sector. And I think this is a bad situation in terms of fighting against inflation expectations, to really allow that people think that the central bank is not primarily focused on price stability, but that it might be following some other objective. This is wrong even if you have a low inflation environment, but with double-digit inflation, this is a problem for inflation expectations, wage developments, etc.
And satisfying answer. I don't spend too much time questioning what are the internal motivations of a given policymaker. I try and look at what the data is, what the actions are of the policymaker, and assess whether I think more should be done. If one has the view that interest rates should be higher, I would focus on that. Right now, what we see happening is that credit is contracting very quickly. High-frequency indicators are very weak. The economy is responding the way you would hope it would when you have monetary tightening. Our concern might be two things. One is that the predicted slowdown is shallow and short in Poland, and I don't know whether it will be sufficient to deal with core inflation of the size that it is. And the second part of our messaging has been that communication should be clear about willingness to tighten further if core inflation, wages, and other relevant indicators do not continue to come down. We think discussing cuts is not useful from a variety of perspectives, including inflation. We think that more clear, consistent communication would be useful. What's interesting is that if you look at the communication in some of the press releases and the inflation report, it's clear on willingness to hike further, that the tightening cycle is not over. But then there's other comments that kind of point to a more balanced view on policy, and it can send different signals. I do think one important consideration is that the IMF approaches this very much from a risk management standpoint. We tend to think that the costs of over-tightening, getting a mistake wrong in the over-tightening direction, are less than the costs of under-tightening and allowing inflation to persist. We are nowhere near deflation. We have inflation. If core inflation starts to adjust much more quickly than we anticipated, policy can be eased as needed. But other governments that we work with see that issue differently, particularly in the context of the war. Some governments see the cost of over-tightening to be much bigger. So I think this is an interesting issue to debate, and that's a big focus of our conversations.
Okay, thank you. I think we had one more question on this side.
Thank you very much, Michał Brzyza-Brzezina, Warsaw School of Economics. I have a question to Tomasz. Tomasz, you said central banks were relatively late with tightening policy, even Central European central banks, which actually acted quite quickly too late to bring this inflation under control. But I have the feeling, and I think you will probably agree, that once the stimulus happened, when the pandemic stimulus, monetary fiscal policy stimulus happened of the size that was there, it was virtually absolutely out of questions that central banks could have prevented the burst of inflation. How much, if you think of the Czech central bank's economic model and do a reverse engineering exercise, say, how much would you have raised interest rates in order to keep inflation even at single-digit levels this year? How much would that be? 20% interest rates, 30% interest rates? And what would be a macroeconomic cause, a huge recession? So once, I mean, we overstimulated, that's fair to say we overstimulated. I don't want to say that was wrong, maybe that was the best answer to the pandemic anyway, but once you overstimulated, must accept that we were not able to bring inflation under control, even if we acted as very rational, forward-looking, perfect foresight agents. Thank you.
Thanks. Another very good question. I think, first of all, I should emphasize that monetary policy, you don't do it with the benefit of hindsight. So this is a kind of theoretical debate. We didn't know what we know now when we were deciding on monetary policy. But if I do this kind of mental expose exercise, being preemptive would have basically required us to start hiking rates during the deepest lockdowns, which I think socially or from the economic political point of view, it would be unacceptable. And actually there was a huge uncertainty. I think at that time the kind of macro-prudential attitude was the other way around. It was rational to think that we would rather overstimulate than start tightening too early, because it was the period of time when we were absolutely not sure that the vaccination process would run as smoothly as it did in the end. We didn't know whether the vaccines would be effective in terms of delivering collective immunity, because there were new versions of the virus, and we were not sure that in the end we would end up with a relatively benign one. There was also a possibility that it would change to something that would circumvent the vaccinations and be still quite deadly. So this kind of exposed mental exercise, it doesn't fit the reality of that time, and it would be extremely hard for central banks to explain that they start tightening very fast in that point of time. At the same time, even though I say that we shouldn't put the blame on finance ministry, in our case, there was also an unfortunate move of fiscal policy, because we had a major cut in personal income tax in the Czech Republic that became effective at the beginning of 2022. So the timing was very pro-cyclical. It had nothing to do with the legitimate anti-virus or COVID support. It was purely an act of fiscal populism. And actually, the beneficiaries were disproportionately more the richer parts of the society. So this one, for me, was a clear policy mistake on all grounds. Long-term fiscal sustainability, counter-cyclical policy, as well as social fairness or equality. So we might discuss that at that point of time, monetary policy should have already been tightening. We started like 5 months or 6 months later. It would have been better to start a bit earlier and more aggressively. But here I think the larger policy mistake was additional fiscal expansion unrelated to COVID support, and very broad-based, non-targeted, or it was actually perversely targeted. So yeah. But I think it's at the same time good to do these mental exercises and to think what went wrong. Okay.
Okay, just, I was not asked anything, but let me just briefly say something about the nexus, and I agree with you. We should call it cooperation of monetary and fiscal. And we should understand that it actually can protect the independence of central banks. Independence within government rather than from government, as it was for a long time understood in the European Monetary Union. Because if you don't cooperate, central banks' hands will be forced. They will not win and regain their independence. They have to be cooperative and take on board what is the concern of central governments and been a pain in the neck of governments. That's their role. They have to also toe a bit of another line. The second, I just want to see, how could central banks have reacted? I think one verdict that this crisis has given is on forward guidance. I mean, this was allowing moral hazard of banks to rely on being, way above the cycle, to be bailed out if any hiccup happens, and it was clear that some hiccups will happen as you go out of such extraordinary times. So that should be scrapped from the instruments of central banks forever.
Okay, so I think we've reached time allotted for this panel. We've had very good discussion. It went beyond what I thought would be the realm of the discussion, rightly so, to financial markets, to different types of dominance, fiscal dominance over monetary policy, financial dominance. I can tell you that in Basel, when governors meet, they also talk about household dominance in some countries, meaning that households have such an influence over narrative that central banks find it difficult to fight the narrative. And then there are also some countries where overall there is a feeling that political parties fight for their survival by making promises through the budget. And this is, I think, something that is quite important to notice, that in the current situation, finance ministries are in a relatively good position with revenue intake temporarily being boosted by inflation. And my feeling is that finance ministries by and large know that they should save a large part of this revenue as a buffer, because they see issues not just in the short term but also in the long term. We haven't mentioned climate mitigation. We haven't mentioned aging at all. So you need buffers on the fiscal side, but political pressure to spend the money that now is flowing into treasuries is very strong. And that's, I think, where this narrative can make a difference, and where central banks and all policymakers collectively should, I think, note that we have long-term issues to take care of, and let's better save this temporary windfall that we have. So with that, let me thank our panel members and thank the audience for being attentive listeners, asking questions, and let's have a round of applause.